Hi guys, welcome back to Kairos Talents, where trading meets faith. My name's Courtney, Christian Forex trader, 8 years experience in the market. Today we're just going to jump straight into some charts. I want to show you a trade that I took on Monday that should have been a win, but because I got a little bit careless, it turned out to be a loss. There are still lessons to be learned, even 8 years in. As always, hit like and subscribe if you are enjoying the content, but without further ado, let's get straight into the charts. Okie doke, so what we see here is a new week. We're on Monday, and first thing I notice is Friday's candles close like this. We have an outside bar that has run up, sweep the highs, and closed particularly bearish. And if I zoom into the 4 hour, you can see that's a complete retrace where the highs have been swept here, and then prices push back down very aggressively and broken structure there. So this says to me that price could be reversing. It's pretty early on, but that's what I'm seeing at first. If we play it forward, I'll show you what I was looking at. Right, so market's open now. As we can see, if I just pop that in there, we've got this break of structure here, which is always an early sign that the market could be turning around, even if it's just for a pullback. And then what I was looking at here on Monday is something like this, for price to kind of pull back correctively into this kind of region and then continue and drop for the week, because it's not unusual for the high of the week to get formed on a Monday around New York open session. So that's kind of what I was looking at and just waiting for price to play out. So if I play this forward a little bit further, okay, and I'll zoom into the 15-minute and I'll show you exactly what I was looking at here. So I'd spotted an order block right there. Just pull this in. I'd spotted this order block, and on Monday I was quite zoomed into the lower time frames, because you can see a little bit more of what's going on. Don't get me wrong, this is based on a higher time frame premise. So I'm not just trading the lower time frames for the sake of it. I'm trading the lower time frames because it is in context with what's happening on the higher time frames. And I'm looking for around New York open, so around 1 o'clock, 12:30, 1 o'clock, I had scoped an entry, which I'll pop on the chart now. So that's where I was looking at for an entry. And you'll see I used 15 pips. Now, this is where I made my mistake. Because I'm so zoomed in here onto the 5-minute chart, I'd looked at that 15 pip stop and I thought, yeah, that's absolutely plenty. That's a big enough stop for the area that I'm looking to trade. And if I play it forward, I'll show you exactly what happened. Okay, so now I'm tagged into the trade. Price does have a reaction in this area, so I'm thinking, great, that's a good reaction. I'll remove risk at these lows here. Until that point, risk on is in the trade. Play it forward even further. Clearly, there's still some buying going on here with this rejection wick. Price moves up. Now, in the trade, I'm in quite deep drawdown, and if I play this forward again, let's zoom out to the 15 minutes so we can move a little bit quicker. I'm still just in the trade, but you'll see when as soon as I zoom out, that stop is a little bit too tight. Play it forward and move my stop just along there. There, right here. I think this was during Asia. Yeah, so it's midnight, I'm asleep at this point. Right there, I am tagged out of the trade. And then price does this. It doesn't even look back. And then if I zoom out to the 1 hour. So at this point, this is where I would have removed risk for a break even. Not a break even, but I would have removed this risk at this point. So no risk on the trade if I hadn't been tagged out, and then the trade idea eventually plays out. The rest of the week, zoom out to the 4 hour, this just continued to fall. The first target was right here at this order block, and you'll see price kind of hits there towards the end of the week. So that's on Thursday. Now that would have been, this is the weekly candle that you see on your right hand side here. So this right here is how the weekly candle plays out, and you can see that my entry was roughly gauging the high of the week. That's what I look to do. I look to ride the weekly candle. Sometimes I catch the high or low of the week depending on which direction I'm trading in. But as you can see, instead of what would have been a 5% trade roughly, as you can see, that's a 5 to 1, 5% trade, I've been tagged out for a loss. Now if I go to the other chart to give you some context again here, start out on the higher time frames as usual. This is a monthly level, which I always mark on my charts. I recommend you do the same because there's always activity around the monthly level that will give you a clue as to the higher time frame direction. So I use two chart layouts. The first one I just showed you, and this is the second chart layout. So let's go down to the 1 hour. And what you'll see is if I play this forward, roughly where I would have been entering. So yeah. So I'd have been entering short there. There's my entry. Now, what I should have recognized is that a 15 pip stop in this scenario, see 15 pips, is not a safe stop. There's no real structure or anything to protect it. And the reason I've used a 15 pip stop is because I was too zoomed in on the 5-minute time frame. Now, if I'd looked at this chart and I'd had any sense in my head to kind of think, okay, what's the higher time frame picture? Where is a sensible place to put my stop in this scenario? It would have been above this high, and even then that's still a 24 pip stop, 23 pip stop, just above the high. That is more than safe, and this is how the trade would have played out in that scenario. Again, target is at this area here where there was an order block on the previous chart. So here's where I'm targeting my first target. Second target is that low there. So it wouldn't have been quite 5%, but it would have still been a 4 to 1. Play this forward. Because the highs get protected, and this is where we've always got to bear in mind what's happening on the higher time frames. If I placed my stop here based on the higher time frames, I would have never really got close to being tagged out, and then that would have been a trade on Monday. If I just let that play out, that would have hit there on Thursday. So yeah, on Thursday around New York, I'd have been out of that trade, and then you can see that price would have pulled back on Friday. So there it is, guys, one of the two trades that I took last week. It is always important to journal and extract the lessons from whatever trades. There might be wins, there may be losses, or even mistakes. There are always lessons to be learned that if you take away from them, they will move you further in your journey and in your skill as a trader. I'm 8 years in and I still make mistakes, just like the one I showed you. But there are always lessons to be learned if you're looking for them. The Bible warns actually time and time again to guard against greed and being too hasty in your desire to make money. Proverbs 13:1 says, "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." Essentially, that just means have patience. There is no rush. I think a lot of people are looking to make money as soon as possible. Even me, I've cropped my stop loss to be too tight because I'm looking at the returns instead of making sure that I am protecting my capital first with the view to make money safely and make sure that I am doing that in a diligent and prudent way. It actually also ties into another principle I got from The Intelligent Investor, which is a book that you can see just there on my shelf, by Benjamin Graham. Benjamin Graham was the mentor of Warren Buffett, who you've probably heard of. And he basically uses this principle called the margin of safety. Sometimes the market can be irrational, it can be volatile. Now, what the margin of safety does, it acts as a buffer against errors, volatility, and sometimes just bad luck. And this reinforces the idea that within your trading, there should be conservatism, ahead of greed, and you should be putting risk management before returns, i.e. protect capital first, make gains second. Once you protect your capital, you can then use that as a platform to make gains. I have a saying that comes from my days of playing football, which is defense wins titles. It always means that when you have a solid defense, when you're able to protect your capital, you will always then be able to make gains off that. When you're in drawdown, your wins are getting you out of drawdown rather than advancing you and increasing your equity curve. Think about it. If I'd used a 23 pip stop based on the higher time frame premise rather than a 15 pip stop, I wouldn't have lost the trade. I would have gained on the trade. There are always lessons to be learned from whatever it is you're doing in the market, as long as you are looking for them. And another great thing about being a trader is that we can always be sure that the market is going to throw us another opportunity. All we have to do is make sure that we are in a balanced state of mind to take advantage of that opportunity when it comes along, regardless of whether the last trade was a win, a loss, or a break even. My new opportunity came along on Friday when I took a euro pound trade short. Risk is removed and I'm holding that trade into the new week. I posted about that in Substack, so you can head over there to see what I said about that trade. And if you're enjoying the chart breakdowns, just let me know in the comment section below, and I can do more of these videos where I'm breaking down how I look at the charts and how I execute my trades. Don't forget to hit like and subscribe. It really helps the channel to grow. And until next time, guys, all glory to God, and I'll see you in the next video.